Most people think the Federal Reserve is supposed to be the adult in the room. The calm voice, the steady hand, the one institution still gripping the wheel while politicians posture, oil burns, markets panic, and ordinary people keep paying more for everything that keeps them alive. I have never trusted that image as much as other people do, and I trust it even less now, because the problem is no longer that the Federal Reserve might make the wrong move. The problem is that the steering wheel itself has split in half. That is the line I want you to hold in your mind while I talk to you. The Federal Reserve is no longer choosing between a good option and a bad option. It is being forced to steer with a wheel that is cracked down the middle. That is the mother line for this whole story. A cracked steering wheel, one half says save the economy, the other half says save the dollar. And the more violently the world pushes from the outside, the more obvious it becomes that those two hands are no longer pulling in the same direction. That is what most people are not ready for. They still think this is a normal inflation story, or a normal recession story, or a normal war story. It is none of those by itself. It is a control story. It is a story about what happens when the central bank can no longer stimulate without weakening the currency, and can no longer defend the currency without tightening the choke on an economy that is already tired. That is where we are now. And the reason so many people will miss it until it hits their wallet is because the system is very good at hiding structural changes behind temporary headlines. One day it is a Middle East headline. The next day it is an oil headline. The next day it is a Fed headline. The average person sees separate events. The serious investor sees one machine coming under more pressure from all sides. That is the way, not event by event, system by system. Now let us begin with the obvious spark, because it matters even if it is not the deepest layer. Oil prices jumped at one of the fastest rates we have seen in months. Stocks fell. The financial press did what the financial press always does. It attached the move to the nearest visible event and told people the whole story was simply an attack involving the UAE and the resulting fear over supply disruptions. Fine, that is the surface. But surface is not structure, and if all you understand is the surface, then every market move will continue to feel random, exaggerated, and impossible to prepare for. The structure was already cracking before the missiles, before the oil spike, before the latest emotional wave of headlines. The Federal Reserve itself had already signaled it. Last week, before the latest market tremor, the central bank held one of its most divided meetings in decades. That matters much more than most people realize, because central banks are not supposed to show division like that, unless the underlying problem has become very hard to hide. In ordinary times, disagreement exists, of course. But it is managed disagreement, quiet disagreement, institutional disagreement that still gets delivered to the public as a coherent plan. This was different. This was the kind of division that tells you the members are no longer arguing about timing inside the same framework. They are arguing about which fire deserves priority. That is an entirely different level of stress. Some at the Federal Reserve are looking at the slowing economy and thinking the obvious old answer: stimulate, cut rates, add liquidity, lower the cost of money, try to make borrowing easier, try to pull demand back up before weakness spreads too far. That is how the machine has been trained to respond whenever growth starts losing oxygen. The others are looking at the same world and seeing something much more dangerous. They see inflation re-accelerating. They see energy costs rising. They see food costs absorbing household breathing room. They see a currency that has already been diluted enough and a bond market that may not tolerate too much more softness without demanding a price. They see the dollar itself becoming the patient. And once the dollar becomes the patient, the medicine changes. That is the crack in the wheel. To save the economy, you usually cheapen money. To save the money, you usually tighten the economy. That is the problem in one sentence. And a system cannot do both aggressively at the same time. This is why I keep saying the old comforting narratives are failing. People still talk as if the Federal Reserve is just deciding when to cut and when to hike, as though it is choosing from a menu. No. It is choosing which pain arrives first and which pain can be postponed a little longer. That is not control. That is triage. Now, let us talk about why oil matters so much in this story, because most people still treat oil as just another commodity. It is not oil as a master input. It sits underneath transportation, shipping, fertilizer, plastics, manufacturing, logistics, aviation, agriculture, and nearly every moving part of the physical economy. When oil rises, it does not stay politely in the energy category. It bleeds into food, it bleeds into freight, it bleeds into retail, it bleeds into household budgets and business margins and government inflation reports. That is why the jump in oil prices matters more than the average commentator wants to admit. And this is where the Fed's favorite inflation measure becomes a kind of insult. PCE inflation, the preferred gauge, strips out food and energy in its core reading. Fine, there is a statistical rationale for that. The official excuse is that food and energy are volatile, so policymakers want to see the underlying trend. I understand the rationale. I still think ordinary people should be offended by how comforting that statistic can sound when the categories being stripped out are the very categories crushing their life. Food and energy are not optional in the real economy. You do not get to stop eating because the Fed wants a cleaner inflation signal. You do not stop driving, heating, shipping, fertilizing, or transporting because policymakers would prefer not to count the noisiest pain too heavily. That is why I say the average person experiences inflation through bills, not formulas. And the bills are rising again. PCE moved sharply higher from where it stood just a few months earlier. That alone is bad enough. But when you lay that on top of energy and food pressures, the lived inflation rate becomes more oppressive than the sanitized metric implies. That is the problem. The central bank may prefer a cleaner signal. Families live inside the dirty one. Now let us connect that to the economy, because this is where the steering wheel crack turns into a real household problem. As energy costs rise, the cost of living rises with them. A family that already felt squeezed suddenly has to spend more on gas, more on utilities, more on groceries, more on all the indirect costs that rise when transportation and input prices go up. And because the American economy runs on spending, what happens next is not mysterious at all. The money spent on fuel is money not spent somewhere else. The money spent on basics is money not spent on everything discretionary. That is how an energy shock becomes a growth shock. Chipotle loses traffic at the margin. Retail slows at the margin. Travel softens at the margin. Hiring becomes more cautious. Margins get thinner. Expansion plans get delayed. The effect ripples. This is what so many people still fail to understand about inflation. Inflation is not just about things costing more. It is about what higher basic costs crowd out. The higher the unavoidable bills go, the smaller the rest of the economy becomes. This is especially dangerous in a country where so many households are already one expensive month away from leaning harder on debt. That is why the credit card numbers matter. The record debt matters. The paycheck-to-paycheck statistics matter. The rising cost of just existing matters because once inflation pressure sits on top of an already exhausted consumer, you do not need a dramatic official recession label for the pain to become real. The weakness begins in behavior before it becomes a neat headline, and that is what the market is trying to process. Not just higher oil, not just a war, not just one Fed meeting. It is trying to process a system where growth is soft enough to argue for stimulus, and inflation is hot enough to punish the use of that stimulus. That is the definition of a cracked wheel. Now add the personnel shift, and the uncertainty becomes even more serious. Jerome Powell stepping down as chair means the institution is not only divided, it is divided on the eve of transition. Kevin Warsh coming in changes the psychology of the whole game because the market does not merely care what the next chair says. It cares what he will actually choose when the contradictions stop being theoretical and start showing up in the next ugly data release. That is what creates uncertainty. Everybody has a speech. Everybody has a preferred public posture. But money does not move on speeches forever. It moves on action. And action is where reputations go to die. If the new chair cuts rates aggressively, that may help sentiment and parts of the economy in the short run. It may also pour more fuel on inflation, weaken confidence in the dollar, and intensify the very price pressure households already feel. If the new chair holds firm or raises, he may defend the currency and signal seriousness on inflation. But he may also tighten into a slowing economy, make credit more painful, and expose how thin the consumer and many businesses already are. That is why words mean less than the transition itself. The market knows the menu is ugly. It just does not know which poison will be chosen first. Now I want to widen the lens, because the worst mistake you can make in a moment like this is to become a headline addict. Every day you will be offered a new emotional stimulus, new conflict, new rate rumor, new inflation print, new political attack line, new prediction. Most of it is noise if you do not know how to process it. What matters more is understanding how the machine behaves when stress accumulates. And this is where most investors split into the wrong camps. One camp becomes apocalyptic. They look at every sign of strain and decide that everything is doomed, markets are fake, and the only safe move is to run entirely away from risk. The other camp becomes blindly complacent. They point to every rebound as proof that nothing matters, that the Fed will always rescue the market, and that every dip can be dismissed without thought because the line always eventually goes higher. I do not trust either camp. The first one usually misses opportunity. The second one usually disrespects danger. I prefer something harder. Understand the danger, prepare for the opportunity. That is the real game. Now let me explain why I feel so strongly about this. The source you gave me walks through a series of episodes from the last couple of years where markets sold off sharply on geopolitical or policy fear and then rebounded violently. Once the trigger softened or policy paused, tariffs announced, market drops. Tariffs paused, market recovers, Venezuela action, market drops, then recovers, Middle East escalation, market drops, then recovers, again and again, the same structure. Most people learn the wrong lesson from this. They learn that fear is fake. That is not the right lesson. The right lesson is that volatility creates entry points for people who already know what they want to own. That is a much more serious conclusion, because you cannot use a downturn intelligently if you have no plan, no watch list, no liquidity, no psychological preparation, and no idea what assets you actually believe in over the long run. Then a downturn is just another panic. But if you already know what you want to own for 10 or 20 years, a sell-off becomes a temporary discount, not a philosophical crisis. That is the difference between a trader's nerves and an investor's system. And the reason this matters so much right now is because the Federal Reserve Division is likely to create more of these unstable windows, not fewer. A central bank with a split wheel is a central bank that will produce confusion. Confusion creates volatility. Volatility creates mistakes for the emotional and opportunity for the prepared. That is the whole point. Now let me say something that many people still resist. Trying to time the exact bottom is one of the most expensive vanity projects in finance. I understand why people do it. It flatters the ego. It promises mastery. It lets you imagine that you will step in at the perfect moment and emerge feeling uniquely brilliant. In reality, most people who wait for the perfect bottom miss the move, or buy too late or freeze entirely because fear talks them out of action when the moment actually arrives. That is why I prefer phased buying. You do not need perfect timing. You need process. A process that buys more. A process that knows in advance what counts as attractive. A process that gets more aggressive as prices get more irrational. That is how adults invest through unstable regimes, not by pretending they can see the future cleanly, by preparing a system that can survive not seeing it. This is also why I respect passive investing more than many people expect. As long as it is done consciously, automatic ETF buying every week or every month is not flashy. Good. Flashy is usually just ego with a brokerage account. Passive buying forces you to do something most people will not do consistently on their own. It forces you to keep acquiring productive assets when the emotional weather changes. That matters enormously over decades, and it matters even more in a world where the Federal Reserve may lurch between competing pressures while the media exaggerates every movement as either salvation or apocalypse. A good passive system does not care. It keeps buying. That is one of the great strengths of automation. It protects you from your own need to feel informed enough to act. Now, I do not mean passive investing is the only answer. I think there is also room for active allocation if you actually know what you are doing, if you understand where money is flowing, and if you are willing to do real research rather than storytelling. But whether you are active or passive, the deeper principle is identical. Know what you want to own before the panic arrives. That is the only way downturns become useful. Otherwise, you will just absorb the same fear as the crowd and tell yourself you are being prudent while you do exactly what broke people always do at the wrong moment. You will sell low, you will wait, you will try to get certainty back before you buy. And by the time certainty comes back, so will higher prices. That pattern ruins more lives than bad stock selection ever will. Now I want to come back to the Fed because that is where the pressure truly sits. The division inside the institution is not just academic. It tells you something profound about the next phase of the economy. The era of clean central bank guidance is over for now. The era of obvious inflation easing is over for now. The era where the central bank could plausibly claim it knew exactly which lever to pull without visibly worsening another part of the system is over for now. That matters because markets used to draw comfort from the illusion of central bank mastery. Even when people criticized the Fed, they still secretly believed the Fed was holding a coherent map. Now the map itself is under dispute. Some members want to reflate, others want to defend. Some are looking at unemployment risks, others are looking at inflation and currency risks, and the leadership transition means the hierarchy that once hid those tensions now looks more exposed. That is why I say the Fed just lost control. Not necessarily total control, not dramatic cinematic control, but the clean confidence that lets markets relax and believe there is one steering logic guiding the machine that is gone. And when that kind of confidence goes, people feel it late. They feel it in gas prices first. Then groceries, then monthly bills. Then rates, then wages not stretching far enough, then market volatility, then the strange realization that the institutions they thought were steering no longer look united enough to be trusted blindly. That is how it arrives. Not in one headline, in a series of experiences that slowly teach the same lesson. If I were reducing this whole source document into one hard Warren Buffett-style truth, it would sound like this. The Federal Reserve is most dangerous when it is no longer choosing among good options, but is instead trapped between saving the dollar and saving the economy, because that is when every policy move begins pushing pain somewhere else. And ordinary people feel the cost long before the experts agree on what happened. That is the real lesson. Not panic, not prediction, preparation. Get your money in order, reduce needless fragility, know what you want to own, keep liquidity available, use volatility as a discount when it is offered, and stop expecting the central bank to remove uncertainty for you. That is not the world you live in now. You live in a world where the wheel is cracked, the roads are rougher, and the people who do best will not be the ones waiting for perfect clarity. They will be the ones who built a system strong enough to keep moving while everyone else was still arguing about which half of the wheel mattered more.